I find it so interesting that some people come out and suggest that they should still use the same methods that our parents used or people that we've known used from 30 or 40 years ago. What we need to do today in today's market is find out what's sustainable with our lifestyle, especially with how things have changed. We don't get married as early as before, and we also know housing affordability is such a concern, with wage growth being non-existent over the last 30 years, whereas housing prices have actually gone up. In this video, I'm going to share with you my whiteboard and how we can look at one expensive property versus two more affordable properties and what those results actually look like. I'm telling you, you're going to be in for a real treat here. If you guys are interested, keep watching. Hey guys, my name is Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now you must have gone out to a shop and gone, I better purchase that one because it's more expensive, must mean there's higher quality. And that's not always the truth. We've seen that numerous times, especially with apartment buildings here in Australia where there were luxury apartment developers, but they've actually gone out and done a shit job. So what you want to do is focus on other metrics apart from just price. And price is just a result of supply and demand. Of course, there are so many other things to consider when purchasing property, but for the purpose of this video, I'm going to address something that's been a big misconception, which is buy expensive properties, that's what's going to grow, and then don't worry about the affordable one because who wants to live there? I'm going to share with you what I think. Now we're looking at one expensive property versus two more affordable properties. Now you could be in this situation or you've been thinking about this because I've had a few conversations over the phone with discovery calls as well as strategy sessions. There's new sessions available, by the way. There's a link in the description. But I feel like this is a conversation we need to have and address. So here what I've got is an expensive property at $800,000 and then two affordable properties at both $400,000 each. Now what we're talking about here are 3-bedroom brick homes. Yes, it is still possible to go and purchase property for $400K, even less than that. Our average purchase price at the buyer's agency is about $386,000. So we can definitely go and purchase properties under $400K. Both purchases are made at 90% LVR, and that's going to affect the cash flow. So we want to keep it both the same and see what that eventuates to. Now we jump in here into property one, which is the $800K property. Now I'm going to run through these numbers fairly quickly, but you can pause the screen and have a look through if you like. The deposit amount here is 10%, which is going to be $80,000. The loan amount therefore would be $720,000. Now in today's market, you could probably get a rate for about 4.6% interest only. And that's what we've got here. And then the monthly repayments will work out to be $2,760 a month, which would then work out to be $33,120 every single year. The rates, insurance, and management fees is roughly about $4,500 for this property. Again, some locations have higher rates, some others don't. And then there's other insurance premiums. Again, I'm not going to be able to cover everything off. You get the point. But the rent here is $550 a week, and that would mean $28,600 a year. In this case, what we want to do is find out our cash flow position. So over here, we've got our rent, which is our income. We want to minus this number and this number, which are our outgoing expenses. In this case, the cash flow would be negative $9,020 a year. Now, the thing is, when you look at the bigger scheme of things, it's not that bad, especially with the rates having gone up so quickly. But what we need to know is apples with apples, and that's what we're trying to do here. Now, what I've gone ahead is looked at CoreLogic's data as of 30th of September and just said, well, if we looked at the last 12 months in a capital city average, what we're going to find is a negative 0.7% return over the last 12 months. Now, again, we're looking at an average. There are markets that have performed way better and there's markets that have fallen a lot more. If you look at, say, something like Adelaide, it's performed really well, but then you look at areas like Sydney and that's gone down by 7 or 10%, and some suburbs even at 12 or 13%. And in this case, the vacancy rate is 1.2%, which again is fairly good, but given that we're in a rental crisis, you're going to find out that the second example is going to blow your mind. So the second example is buying two properties at $400K each, and the deposit, the loan amount, and the loan rate, and the monthly repayments are all the same. So I'm not going to cover that off again and bore you. But the rates and insurance management fees will actually go and double because we've got two properties. So that's what we've done here at $9,000 versus in the first example is $4,500. Now here the rent is $440 per week per property, which means $880 per week, and that means $45,760. When we go ahead and you minus all of your costs against the rental income, we come to $3,660 positive cash flow across both properties. So both of it combined, your portfolio would be positive. Now you do have to factor in tax that you're going to pay, but I'm looking at pre-tax calculations. This is what a bank will look at. And the important part here is not so much, oh, well, I'm negative 9,000 or I'm positive 3,000. These are small numbers. What you want to do is get the highest amount of asset value in your machine, because once you've got the highest amount of asset value that's productive in good locations, you're able to build phenomenal wealth. That's the whole idea here. And the banks are going to look at your cash flow, and if it's down by 9,000, well, it's whatever your income is minus 9,000. Whereas in this case, if we're positive, they could then use that income as part of our investment portfolio income, and that could end up increasing our borrowing capacity. So in this case, what I've done is this property would be purchased regionally. And again, we've looked at CoreLogic. As of 30th of September, the last 12-month average is 10.1%. So a significant difference between what we were getting in the capital cities 12 months ago versus now. Again, the average regional market, which was performed at 10.1%. Here is where it gets glaringly obvious around what a better option is. Here, the vacancy rate in one of the suburbs is 0.1% and the other is 0.2%. It's next to nothing in terms of what is available there as a rental dwelling for people to tenant. So on the surface value, you can see there's a minute difference between the cash flow, but what's more important and something I want you to focus on is that we need both capital growth and cash flow. And if you're someone that has been thinking about what everyone has basically been saying, which is expensive properties grow faster, I can tell you I've seen plenty of examples where that is not the case. And what's more important is if your cash flow is in good position, you as a young individual can go out there, enjoy the lifestyle, just like I have and gone out there. I travel a lot, but also not have to worry about my portfolio. Yes, during times where the RBA's increased rates so quickly, the portfolio takes care of itself. I'm not in a position where I'm already negative 9,000 and then I've got to factor in the RBA's increasing rates, which means now it's not 9,000, it might be 12,000, 15, and then 18, and that's just on one property. So that's going to cause me a lot of financial stress, and it then starts affecting my day-to-day lifestyle. I don't want that. What I want is the portfolio to exist, and it needs to exist on its own. It needs to be sustainable. So if I lose my job or I decide I want to invest in other things, I need that portfolio to keep growing and doing its thing in the background. The machine keeps growing without my input. That is very important, especially when you're looking at doing this in the long term. Now, I've got a couple of really important points here that I want you to focus on, is that not only do we have all these upfront benefits like the cash flow as well as the capital growth, and in this case, vacancy rates are so low, you're probably going to be in a position where rental growth is going to be a lot quicker as well. There are three important points here, is that you've diversified your risk. You're in two different locations. That means that if something happens in the one location and your one property has all of your risk, all of your money in that place, you're screwed. Your tenant leaves, you're going to zero. You go from $550 a week to zero. In this case, if you can go out there and you purchase two investment properties in two different locations, you take advantage of different property cycles, because when we go back into a normal term, you're going to see different markets react at different times. And in this case, your portfolio keeps growing because you have properties everywhere. Then the other side to it as well is that if you did have one of your tenants leave the property, you still have enough cash flow coming in from the second property, which means you don't go from 550 to zero. What you're doing is you go from 880 to 440, which means you're still generating cash flow. This becomes very, very important when later on in life, when you're relying on this income to be able to live your daily life and your tenant decides to leave, you've still got some sort of income coming through if you've got multiple properties. If you look at just focusing all of your energy and all of your money into the one property, you're going to screw yourself over in the long term because your yields aren't going to be that great, which means rental income is not going to be amazing. And not only that, all of your risk is associated in that one property where if the tenant leaves, it's vacant for a couple of weeks, you're screwed because you earn zero income. The other part that's most important, especially for people like yourself that are watching, based on YouTube analytics, you're fairly young, so congratulations, you're starting well, but it's a lower cost to start. Why would you get into real estate and go, oh yeah, I've never bought a property, I'm gonna go jump in and take an 800K or 700K loan? No, dip your toes before you jump into the ocean, and in some cases, you wouldn't even have to jump into the ocean that far deep. What you can do is have the right guidance, the right team to be able to do it, and if you have a lower barrier to entry to start, chances are you're gonna start quicker. And that is the main point here, is that what you wanna do is start actioning, start getting into the market, versus still holding on to this belief that you need a 20% deposit, $150,000 to $200,000.
Oh my God, I can never start and I'm gonna sit there and troll people on the internet.
No, you don't wanna do that. What you wanna do is do what the successful people do, get in the right conversations and the right team. And if you are interested in sort of having a chat with myself to build a portfolio, strategy session, as well as a discovery call, there's a link in the description below, or send me an email and that'll be in the pinned comment too. And finally, the positive cash flow. I've said already on this channel how important it is to have a portfolio that is self-sustainable. That means that it doesn't rely on your income. And I remember in 2020, I had people that were stacked up in cash, had no form of cash flow, and they were suggesting that they shouldn't buy anything, and they should stay on their cash in case they lost their jobs. I'm like, if you lose your job, you've got no income coming through. If you're in a position now that you can purchase property in a good location, you'll not only get the capital growth, but the cash flow means that you've actually got some income coming through to sustain your everyday life.
They didn't listen to me, and now we're here 2 years later, and well, it is what it is.
I hope you guys have enjoyed this video, a breakdown of something that has come up so many times that I felt like I needed to make this video. You can go ahead and substitute your own numbers in an Excel sheet and figure out what option works best. I've done this numerous times for myself as well and for clients, and we've always come back to the same answer, which you've also alluded to by now. If you guys have enjoyed this video, definitely smash that like button, subscribe if you haven't already, and I'll catch you guys in the next one. Thanks guys.